Good morning, everyone. Welcome to Professional Insights, brought to you by the National Referral Network. This is where we share professional insights for your use and edification. We are going to bring on our guest in just a second, but before I do, please hit the like and subscribe button so you can receive regular content from us, because this is all good stuff, ladies and gentlemen. Let's bring in our guest. Hello, Kory. How are you?
I'm doing terrific. Excited to be here, and good work on these, by the way. Valuable information in a bite size, which is awesome. And yeah, looking
Thank
forward to
you.
chatting with
I'll send you your $10 for saying that.
you. Right. Yes, please.
This is Kory Kavanewsky. I just learned how to pronounce his name correctly. He is a mortgage broker from San Diego. Really impressed with Kory, his level of detail, his knowledge, his professional demeanor, all of it. Really top shelf stuff. So, Kory, I'm excited to talk to you. We're going to spend some time on talking about reverse mortgages, I think, for the bulk of our presentation here. But before we do, since anytime somebody meets you, they have questions about the direction of interest rates and should I buy a home now? Should I wait? Should I refi? All this stuff. Let's speak to that for just a minute. How do you assess the current environment and where are we going to go?
Yeah. Well, yeah, that is the first question I get, no matter where I am. Where are rates? Where are they going? Where are they headed? What should I do? And today specifically, here we are the day after Inauguration Day. Interest rates are improving a little bit. Nothing crazy, but going in the right direction, as we like to say in the mortgage industry. Rates sit today on a conventional sort of ordinary mortgage right around 7%, which for some people is not crazy because many have seen much higher interest rates. For others who have not, who have really come up over the past, let's say, 20 years, where we've had quite a low interest rate environment for almost all of that period of time, 7% is just ridiculous to some people. I can't fathom it. And I hear almost daily, both sides of the argument. But very commonly I'm hearing from people, well, I'm not going to buy a home if my interest rate's going to be 7%, which in my opinion is just a huge miss. I know my parents bought their first home with a rate of 13%. They've done quite well on their home, and they are not alone in that. Even going back just a couple of years, if you look where rates were at a high level, in fact, we've touched 8% over the past couple of years. Even so, the housing market has done, under the circumstances, quite well, with a lot of economic pressure and some significant challenges. So, Mike, I tell people these high interest rates, they are your friend, and you just don't know it. In most markets, we sit here in Southern California right now, and the higher rates has slowed the market a little, enough to where a buyer might be able to buy a home without paying $100,000 over list. A buyer may be able to buy a home and have the seller make some reasonable repairs and or some concessions.
Yeah, I know. Yeah, go ahead.
This was not the case just a couple of years ago. So if you wish lower rates for everybody, just remember, we look back at COVID, which obviously was an extraordinary dip there in rates. But look at the frenzy it caused. And look, if you bought a house during COVID, today you are happy you did it. Don't get me wrong, because you've seen the appreciation. And of course, you've got a very low rate, a record-breaking low rate locked in, if you're smart, for 30 years. So you're happy about that. But those who were negotiating in that environment had a tough time. I mean, they had to overpay. They had to almost buy the house with their eyes closed. The seller was absolutely driving that ship, and you weren't getting any concessions or any breaks at all. So I would argue now is actually a better time to buy a home than that time was, because you can't change the price that you paid for your home. You can't really change the location of your home. Get the home that you want right now, negotiate to the best of your ability. And when rates come down, and they will, this is a cyclical thing, take advantage of that. You're not going to see 2.5% more than likely, but you'll see something better than 7%. And I think you'll be quite happy you pulled the trigger when you did.
I bought my first home in 1989. That's how old I am. bought my first home in 1989. Uh, and two things were happening at that time that very seldom happen. You had a high interest rate environment. My first mortgage was over 11. And then you had a super hot real estate market. Those two things very seldom converge. And you're right. A couple of years later, when interest rates came down, I just refinanced out of that high interest loan, and like, wow, now I got some breathing room here. Okay. So I think that's a lot of what you're referring to, but I want to shift it in the time that we have. I want to shift to talking about reverse mortgages, because we get a lot of questions about this. I think they're very, very misunderstood. I think some people view them as predatory. They get a bad rap in some circles. A lot of misinformation about them. So let's set the record straight here today, if we can. So walk us through, if you're looking to enhance your retirement income and you own your home, how should someone approach this subject? What questions should they be asking? What should they be considering?
Well, anyone who is considering any sort of financial instrument, a reverse mortgage, an investment, should ask a lot of questions. Should challenge the individual the expert that may be presenting the information. So, by no means would I tell somebody who's looking at a reverse mortgage to just, hey, don't worry, it'll be all good. You should understand, exactly what it is that you're doing. Now, you mentioned own your home. Sometimes people say that when they mean own the home outright, which is not actually a requirement when it comes to a reverse mortgage. You don't have to own your home outright. But let's first look at, like, why do people think that this might be predatory, or why do they have so much hesitation even without really knowing much about it? And I think just simply the name of it, reverse mortgage, creates some angst, right? I mean, if you think about the person who is getting a reverse mortgage, which, by the way, is someone who's 62 years or older, okay, just think about what they've been working on for the last 20, 30, 40, 50 years. What they've been brought up to think is that they should get their home paid off, and that they should work as hard as they have to do in order to get that done as quickly as they possibly can so that they can enjoy retirement. That's the path they have been on for quite possibly decades. And here we are, right in the title of this loan, reverse mortgage, saying, no, that's all wrong. You should be going the other way, right? So that is somewhat contradictory for people. And I think just hearing that alone is enough for them to go, there's no way I want to add to my mortgage. That's, I think, the common response. And that's what you're doing when you have a reverse mortgage. It's as simple as this. Your loan balance, whether it starts at zero, it starts at 100,000 or 200,000, each month, your loan balance is going to increase. It's a reverse amortization schedule, essentially, although there is really no schedule, and I'll get to that in a moment. But I think the biggest hesitation is just, well, I don't want to owe more on my home in the future than I do today. And of course, that's a natural reaction, right?
Well, you're stripping out the equity is what you're doing. At the end of the day, you're taking an asset that you own that you can't turn into income and turning it into income.
Turning it into income and or removing a liability, right? Because you may have a mortgage today, and that mortgage payment may be $2,000 a month, and that may be preventing you from being able to live the life that you want to live, to make the investments that you want to make, to pay for the healthcare that you need in your life. And so it could be giving you income, or it could be eliminating a liability. In either case, it's financially having an impact for the positive. And, you said strip out your equity, or you're using your equity. And that's not an untrue statement, because you are increasing your loan balance. But one thing we have to look at too is what is appreciation going to look like moving forward? In other words, if I take money out of my IRA, you can look at that as if you're depleting an asset, but I mean, if I get to retirement age, I've saved in my IRA for retirement.
Well, that's an asset you're supposed to deplete.
That's correct.
The IRS makes you deplete it.
That's right. But you may even have a different type of account. Maybe it's not a qualified retirement account. The point is that, you're saving this money for what, right? Now, when you get to the point where you could potentially use your home with a reverse mortgage instrument to help either alleviate a liability or create an income, I just don't think it should be considered automatically to be off limits. Because look, if you might be taking $10,000, $20,000 a year out of this reverse mortgage, okay, and you may have $1 million home that is appreciating at a rate of say 5%, which is a relatively modest appreciation rate, that's $50,000 a year. So you're growing by $50,000 a year. You're taking $20,000, $30,000, $40,000 out. You're not even actually going backwards.
Mhm.
Your loan amount is going up, but your overall asset is keeping up with it in most cases. In fact, this is why the government is so willing to insure these loans, because they're quite confident you're not going to put yourself, or them for that matter, in a position where you're going to somehow owe more than the asset is worth. It's almost impossible.
So let me ask another question here. So let's suppose, just for the sake of making the math work, somebody has $500,000 of equity in their home, okay? And they're going to take out a reverse mortgage, which is going to give them an income stream of X, okay? Can they outlive X?
Well, so there's no chance that the income will ever stop, because the income goes for life, regardless of the
Regardless of
value.
how long they live. So if they live till they're 103, which would surpass the mortality expectation, they still get paid?
100%. They could live to 150 years old. They would still
Okay.
get paid every single month. Okay. The home value could have absolutely tanked. I mean, we could be reliving 2008.
Right.
Okay. And you could owe now $300,000 on your home that is worth $100,000, and that check will continue to come in every month. And this is the quote unquote risk that the government takes when they make these loans. And they take this risk knowing, what the likelihood is of that
So in
happening.
other words, it's like the way pension funds operate. You're taking
100%.
mortality risk, basically, is what you're doing.
Yeah. It's
So
actuaries putting this stuff together. They're
right.
looking, when
So
you get the loan, they're looking at your age, your age at the time of getting the loan, and the
right.
value of the property.
So it's essentially an annuity. So if somebody takes out a
It
reverse
is.
mortgage, let's reverse that. They take out a reverse mortgage, they die next year, and they have gotten 12 months worth of payments. And what happens to the remaining stream of payments? Can it be left to a beneficiary, or is it revert back to the mortgage company?
No, the income is going to turn off unless the borrower is married and their spouse, who is now widow, remains in the home. Okay,
Mhm.
then the income and everything will just continue the way it was.
Well, right, because as far as the IRS is concerned, married couples, especially those that file jointly, are one taxpayer, not two.
And that's part of the reason, but this is also just how reverse mortgages work. There are
Okay.
rules that say if whether you pass away or you leave the home, let's say you go to a long-term care facility and you leave your spouse in the home, then your spouse will continue to receive the benefits. But getting to your exact question, which is someone passes away, okay, at that, and let's say that's the last of the couple, or maybe the
Right.
borrower was single. In that case, distributions will cease. Okay. And now this is the big $1 million question everybody has. What happens now? Well, the same thing happens here as would with an ordinary mortgage.
Mhm.
There's a loan amount that's outstanding. The bank is going to tally that up. They're going to say, listen, you started with a $200,000 loan. You took out $50,000 over the past couple of years. You now owe $250,000. One way or another, this debt needs to be repaid. So the heirs can refinance the loan into a forward loan. The heirs can, write a check for $250,000 to pay off a loan if they have that kind of money.
Right.
They can sell the home for $1 million, pay off the debt, and be left with the 750. So it's
So
just the same you
how
would
much
do with any
time?
other loan.
How much time do they have to do that? Because the vision
Yeah,
I've been, there's different kinds of homes, right? So someone has a
sure.
very neat, tidy track home where they pay homeowners dues. It's all pristine. That might sell very quickly. Then on the other hand, a home that's on a couple of acres with truck parts in the front yard, that
Yeah.
might take a little longer. It might be in disrepair. There's circumstantially all kinds of different things. How long would they have to do all this? Because settling an estate is a thorny thing sometimes.
Yeah. So typically it's a year to get the situation figured out and resolved. Keep in mind, you don't have to sell. That's not the only solution. But lenders typically also will extend in 6-month increments for another year, so 2 extensions, as long as the people who have been left the property can demonstrate that they are making an effort. They've listed the property, they've marketed the property, whatever it might be, whatever it is they're working on is in progress, and they're not just sitting around taking advantage.
Okay.
In my 25 years or so of doing this, I've only seen, really only one case, and frankly, it was fairly recently, where the bank was applying some sort of pressure, to actually get it sold. You keep in mind, interest is tallying during this time, so most of the time, people are motivated to get through it.
What about homes that are not owned by a trust and the whole thing goes through probate? Because the
Sure.
probate backup in LA County, I don't know what it is. I think it's over 2 years now. I don't know what it is in San Diego County, but it's usually long. Um, if the home is in probate and yet there's an outstanding debt on it, the heirs need to pay, and that had a reverse mortgage on it, how does all that get reconciled?
Yeah, so in San Diego County, not that it matters, but it's about a year, and the banks are having to deal with that. Again, that you're making the effort and your hands are tied. So the bank is just tallying interest over that period of time. But that would be an example where they can see that you're making the strides that you can make towards a resolution. Now, of course, as you know, to pass away without a trust when you own something as valuable as real estate, and presumably some other things, is just really unfortunate. That shouldn't be happening.
Now, what about if you're home, and I'm just because I live in LA and half
Yeah.
of West LA is on fire, or at least it was. What if your home burns down?
Mhm.
I don't know. I'm gonna guess that a number of homes that were lost during the fires had reverse mortgages on them, because
Yeah.
if you drive through some of those areas, you see these ultra opulent custom homes next to something that looks like it's a little rundown that was built in 1960,
Yeah.
because those people probably bought it in 1960 and never moved. And
Sure.
I think some of those people may have had reverse mortgages on it. What happens under those circumstances?
Yeah, I mean, these circumstances that we're dealing with now with the fires are just absolutely terrible and are unprecedented and probably get some sort of special treatment. But typically the rule is that if you can't occupy your home for more than 60 days, then you're supposed to relinquish the reverse mortgage. So an example of this would be, look, you go to the hospital, you're there for a couple weeks, no big deal. You go to the hospital and you decide, I can't live at home anymore. I have to go into an
Right.
extended care facility. Then you're supposed to volunteer that information and get rid of the reverse mortgage by refinancing or selling or paying it off.
Okay.
In a case where your home is burned down, you can't occupy the home.
Right.
And so you would probably technically fall within this 60-day thing. However,
Mhm.
I think if you were to contact your servicer and explain the circumstances, provide evidence of the situation, and elaborate on what your plan is, my plan is to rebuild and get back in and that sort of thing, then I think you're going to see a special, it's going to be considered a special case, kind of
Okay.
like deferment almost.
Now, let me ask the question that often comes up for seniors. Is there a circumstance under which the mortgage holder can take the home,
Yeah.
can move someone out?
No, it's not possible. And this is the biggest misconception when it comes to reverse mortgages. Many people think, well, I owe nothing on my home. I may only live for 10 more years. I'm going to owe $100,000 on my $1 million house, and the government's going to get all the money. There's no circumstance where the government can take the home. I mean, I suppose if you were to be foreclosed on, that would be a circumstance. But the only way that you can be foreclosed on is if you violate the agreement. Now, there's no monthly payment on this mortgage. So typically when people think of foreclosure, they think, well, I didn't make my payments, and so the bank is taking my house. There is no payment to make with a reverse mortgage. This is the beautiful piece about it. But there are ways in which you could violate the agreement. Okay. There are people, unfortunately, that take advantage of these sorts of things, these sorts of tools that are provided by the government to benefit our seniors. If you refinance your home into a reverse mortgage and 20 minutes later you move out and make the property a rental property while you go and live somewhere else, that's not okay, and I suppose, a case where the lender could foreclose.
Okay.
So, even in that case, though, as you probably know, with a foreclosure, you're still getting the equity. It's a
Right.
nasty process. No one wants to go through it, and there's costs. But as the owner, you still get the equity.
So as we wrap up here, in just a couple of minutes, walk me through, like, 1, 2, 3. If someone is considering a reverse mortgage, what questions should they be asking? Like, what are the top 2 or 3 questions they should be asking? What else should they be thinking about? Real quick, give me that in a couple of minutes if you can.
Yeah. So, I mean, I would say, first of all, what are the costs to get in? This is where you can see some unfortunate circumstances where you've got bad actors overcharging seniors. So you understand your costs. By the way, the costs are not particularly low for this type of loan. The benefits are abundant, but the costs are not particularly low. So understand your costs. The other thing I see is that people oftentimes they just assume because they're 62 and because their home is worth a lot of money, they're going to qualify for the reverse. And that could be the case, but there's the actuarial piece of it, which is exactly how old are you, exactly how much is the home worth, and exactly how much you owe currently. The older you are, the closer you are to death, right? So the more willing the government is going to be to make a loan and or make a larger loan. So understanding how your age and your equity fits in. And then the other thing is, what are the steps? Here's one thing I just absolutely love about the reverse mortgage. Step 1 is to speak with an expert. Step 2 is to go through counseling. So the government says you must go take a counseling course from an intermediary, a neutral third party, who will not only educate you on the reverse mortgage and who is obliged to tell you all of the details you must know, but they will also look at the specifics that the expert provided to you and give you not their opinion, but facts about it, so that no stone is left uncovered, so that there's no fast talkers out there that can just convince someone to do this without going through every single detail. I love this about the reverse. I think more mortgages should require this sort of education. It's a 1 hour or so course. You can take it online. You can take it over the phone. I think you can take it in person, even in some places. And you get a lot of knowledge about it. Makes you feel a lot better about what you're doing or maybe not doing. So those are some things I think people should know.
Okay. Well, Kory, listen, thank you so much for all this information. This is a topic we circle back to occasionally. It seems like it's one that a lot of people have questions about and want to know more about. So thank you for your expertise. We will be back next week with more professional insights. Again, hit the like and subscribe button if you want to receive our content regularly. And again, Kory, thank you so much.
Thanks for having me, Michael.